kinds of things that we can do when we have a marriage situation. And I already talked about what the requirements are to get the patient on Medicaid. But when there's a spouse at home, there are spousal anti-impoverishment provisions that are built into the law. So many times, the very first thing we do is we're going to transfer all the assets from the ill spouse to the healthy spouse. And again, we've got to keep second marriage concepts and different things like that in mind when we do that. Transfer sounds like a bad word, but transfers between spouses are exempt. So we can transfer all the assets to the well spouse. However, remember what I said earlier, every client is an estate planning client. What happens if the healthy spouse now dies first? And we got an I love you will. Everything now passes back to the patient and we're immediately disqualified for Medicaid. So one of the first things we want to do is get a will in place with a special needs trust, SNT, to take care of that eventuality. And the statistics are quite high on the earlier death of the caregiver spouse. So it's something that we really got to work on, and it's beyond the scope of this discussion, but caregiver spouses need to think very carefully about their own care and try to get some help before you run yourself too far into the ground. The anti-impoverishment provisions, there's also some other things on your Medicaid fact sheet here. The spouse is allowed to have $109,560 in countable assets. If they have more than that, the techniques for dealing with those excess assets include all the other things we already talked about with a single patient, but also in the spousal context, we have another rule that allows us a lot of latitude, and that is basically, I said there was a limit on how much income the patient can have. There is no limit as to how much income the well spouse can have. So if we had an extra $500,000 of assets, we could buy a short-term annuity, say a 2-year annuity, that would pay back $20,000 a month, and we would have converted assets into income, and within 2 years the spouse has all the money back and the other spouse is still on Medicaid. Along the lines of what I said about the inheritance previously, I don't think quite the same way when it comes to worrying about the financial security of the spouse. We want to do everything we can to help the financial security of the spouse. I said short-term annuity. Actually, in Florida, you can actually use a promissory note strategy where you don't need to deal with an annuity company. You can lend the money to one of the kids or a trust for one of the kids to invest those excess assets and convert them into income. There are also provisions that if there's a shortage of income around, and let's say the sick spouse has a decent income, the spouse at home only has a couple $100s of income, then it's built right into the spousal anti-impoverishment that we can assign some of the patient's income to the spouse at home. And those numbers are on your fact sheet too, but basically, with no questions asked, we can get the spouse at home up to $1,840 a month. If we can prove excess shelter costs, we can get them up to $2,839 or something like that per month. And then in some situations, where that doesn't really work too well for us, we will actually go to court before we apply for Medicaid and get a court order that the spouse his income has to get transferred to the spouse at home. And again, we're worried about the financial security of the spouse at home. There's one little part about that I wanted to mention. We're going on pretty long. We're getting back into a two-winded routine. Ordinarily, I don't speak with a PowerPoint but that's one of the advantages of getting new blood in the firm. Brooke has helped rejuvenate me and get me going there. And part of the idea was with the PowerPoint was to try to make sure I cover these points, but I don't talk too much. Okay, and we did, like I said, it's going to be hard to keep from interrelating some of these concepts, and we've already talked about most of this, that, Medicaid has look-back rules, VA doesn't. That doesn't mean they might not institute some in the future, and they're also trying, as I mentioned, I think they're trying administratively to make it a little harder to get the benefit, and that's kind of the way they're controlling this until they get some legislation. And again, we talked about trying to fix anything that's wrong. We can repay a bad transfer and then find ways to shelter the money appropriately. We can repay it by doing a personal care contract or something. The point is, we want to fix any of these problems before we get a Medicaid application going. And at the bottom, continuing duties of benefit recipients. If we get somebody on Medicaid and the circumstances change significantly, you have a duty to let Medicaid know within 10 days. So we want our clients to know, let us know, if we can help them. Otherwise, we want them to report things to Medicaid that change. Just this doesn't relate to Medicaid at all, and actually we have if we have time for it, we've got a case study coming up shortly. But I did want to mention taxes real quickly because the President just signed a new tax law on December 17th, and for folks in the audience that it might impact, I just wanted to mention some of the provisions of it. And most of this is going to apply to wealthier folks. But, and there's a long history of what happened, but you may have seen some of the media on the new tax bill was an extension of the Bush-era tax cuts. And if the President hadn't passed it on January, we would have reverted to a $1 million estate tax exemption and rates up to 55% on the excess of that. So, if somebody had a $2 million estate, we'd owe $550,000 in taxes. Well, they enacted this new law that changes our estate tax exemption, our gift tax exemption, and our generation skipping transfer tax exemption to $5 million. And it added in, and the rates are reduced down to 35%, which is a lot more livable than 55%.